Good morning. Thank you for listening to our prepared remarks for the Conagra Brands second quarter fiscal 2026 earnings. At 9:30 Eastern this morning, we will hold a separate live question and answer session on today's results, which you can access via webcast on our investor relations website. Our press release, presentation materials, and a transcript of these prepared remarks are also available there. In our presentation this morning, Sean Connolly, our CEO, and Dave Marberger, our CFO, will be making some forward-looking statements. And while we're making those statements in good faith based on current information, we don't have any guarantee about the results we'll achieve. Descriptions of our risk factors are included in our filings with the SEC. We'll also be discussing some non-GAAP financial measures. GAAP to non-GAAP reconciliations and information on our comparability items are in our earnings release and presentation materials in the investor relations section of our website. I'll now turn the call over to Sean.
Thanks, Matthew, and happy holidays, everyone. Thank you for joining our second quarter fiscal 2026 earnings call. Let's begin with the headlines for the quarter on slide 4. As expected, the macro environment remained challenged with a few new twists emerging this past quarter. In this dynamic environment, we're executing a tailored portfolio segmentation strategy, drive volume growth in frozen and snacks while maximizing cash in staples. And though there was quite a bit of noise in Q2, both in the scanner data and our P&L, the underlying story is clear. Our in-market execution is working and momentum is building. We're seeing continued upward inflection in our growth businesses of frozen and snacks, where we're strategically investing margin to drive volume performance. In addition, we're on track in our cash businesses, largely in our staples portfolio, where we've taken inflation-justified pricing to protect margins. Our supply chain delivered another quarter of impressive performance with record service levels and strong productivity. We also launched Project Catalyst, a major initiative leveraging AI, data, and other new technologies to unlock significant value across our operations. You're going to hear much more from us on this in calendar 26, so stay tuned. Based on our first half performance and everything we're seeing in the marketplace, including underlying consumption trends, inventory dynamics, and our robust investment slate, we have high confidence in our plans to deliver a return to organic net sales growth in the second half, and are reaffirming our full-year guidance. Before I get into the business performance, let me provide some context on the macro environment on slide 5. As I mentioned earlier, consumer sentiment remained fairly weak in Q2. Household budgets continued to be strained, and value-seeking behavior persisted, with these pressures weighing most heavily on low and middle-income consumers. We also saw some unanticipated dynamics this quarter, many of which we expect will be timing related. The government shutdown spanned about half the quarter, along with the related pause in SNAP payments. There were also two noteworthy dynamics related to weather. First, we had our first October in 10 years without a hurricane hitting the continental U.S. We had planned for a normal hurricane season. We also saw a slow start to winter. Finally, during our Q2, we often see retailers begin to build inventories ahead of the holiday season. However, this year, we shipped behind consumption, which we believe is due to two discrete timing factors. First, the government shutdown and pause in SNAP payments led some retailers to slow down ordering near the end of the quarter. Second, several of our large customers made timing shifts on their promotional calendars, particularly impacting our frozen business, which moved their inventory build into our Q3. Given those dynamics, there was an unusual amount of noise in our top line, both in the scanner data and the P&L. In the P&L, undershipping consumption shaved about a point off of our Q2 net sales. We have since seen these shipments start to materialize in December. As for the scanner data, this chart illustrates the unusual volatility in the quarter, mostly tied to the aforementioned weather dynamics and the pause in SNAP payments. So to parse out the noise and provide a clearer view of the underlying state of the portfolio, let's look at our business at a category level. Starting with frozen on slide 7. As you can see on this chart, in Q2, we were wrapping an exceptional quarter a year ago, where volumes were up 3%. You can also see the ensuing drop-off tied to last year's temporary frozen supply constraints we've discussed previously. This year, our focus has been on restoring our frozen momentum, and it's working. In Q2, while year-over-year growth softened due to lapping the very strong year-ago period I just mentioned, we drove strong growth on a two-year basis, sustaining the positive inflection we saw in Q1. And importantly, 90% of our frozen portfolio held or gained volume share over the same period. This tells you that our strategic investments are working and we're winning with consumers. As for performance versus the record year-ago period, we're pleased with where we are, particularly given the timing shifts of some major frozen promotions to Q3. Speaking of promotions, Slide 8 shows our frozen promotion recovery also continues to inflect in the right direction. We're pleased with this trend and look forward to further progress in the second half of the year. Now let's take a look at our largest frozen business, single-serve meals, on Slide 9. On the left, you can see the continued upward inflection of our volumes across the last year, quarter, and most recent 5-week time period. You also see that trend versus 2 years ago. Why show the 2-year look? Again, it's because in Q2 a year ago, we delivered extremely strong performance that we did not expect to exceed this year, having recently emerged from our supply impacts. The timing shifts of some of our major frozen promotions into Q3 further support this point. And even with the promotion shifts, when you look at the trend versus 2 years ago, you can see we've returned to solid growth at plus 1% in the latest period. What's particularly encouraging, and you can see this on the right side of the chart, is that our 52.9 market share remains far and away the market leader and very close to last year's outstanding level. We're seeing a similar story in frozen vegetables on Slide 10. Bird's Eye continues to perform very well. On the left, you can see strong momentum building across all time periods, with the most recent data showing more than 3% volume growth versus a year ago and more than 9% versus 2 years ago. On the right, you can see we've recovered the share we lost in the wake of our supply challenges. In fact, we're now above 19% share and up 130 basis points versus 2 years ago. Our strategic execution is working. We've invested behind the brand, restored our supply, and are winning with consumers. Moving to snacks on Slide 11. Once again, our snacks business delivered strong performance in Q2, significantly outperforming the snacking categories in which we compete in both volume and dollars. In fact, this represented the 4th consecutive quarter of dollar sales growth in our snacking categories. We have exactly the right snacks business for today's consumers. Our portfolio of protein-centric, high-fiber foods is in demand and on trend. In an environment where some of our competitors are struggling with snack portfolios weighted towards salty and sugary, carb-heavy products, our snacks are resonating strongly with consumers. This is a strategic advantage that positions us well for sustained growth. This is highlighted by our protein-centric snacks on Slide 12. Our meat snacks business, including Slim Jim, Dukes, and Fatty, posted 5% volume growth and 4% dollar growth in the quarter. In fact, Fatty, our most recent acquisition, is on track to double in size in fiscal 26. Our seeds business, including David and Biggs, posted 4% volume growth and 4% dollar growth. Protein is exactly what consumers are seeking, and we're delivering. On Slide 13, I want to highlight an important dynamic that's benefiting our Slim Jim brand. Compared to our broader portfolio, Slim Jim is disproportionately represented through the convenience channel, which includes the C-stores attached to gas stations. Accordingly, consumer traffic for this channel is correlated to gas prices. When gas prices are high, people filling their tanks tend to save money by reducing the number of trips inside the convenience store. This weakness in C-store traffic impacted Slim Jim performance in recent years. With gas prices having moderated, the trend has reversed exactly as we expected. C-store traffic has improved, and so has Slim Jim's performance in this channel. Importantly, as you can see on this chart, Slim Jim's volume performance in broader multi-outlet channels has remained positive throughout. Now let me talk about the sweet treat side of our snacks portfolio on slide 14. Two of our sweet treat businesses, Swiss Miss and Snack Pack, experienced unusually high costs due to cocoa inflation. We raised prices to offset that inflation, and because of the strength of these brands, the impact has been very encouraging. We're seeing the desired effect on dollars, Swiss Miss up 14% and Snack Pack up 8%. We're also seeing volumes hold up despite the incremental pricing, with Swiss Miss up 5% and Snack Pack up 1%. Turning to slide 15 and our canned products. As I mentioned earlier, we planned for typical hurricane activity during the quarter, only to experience the first fall in 10 years without a hurricane reaching landfall in the U.S. This, combined with the later start to winter, impacted consumption. In addition, we've taken inflation-justified pricing on these businesses due to rising steel costs. The early elasticities are on track with our expectations. What's most encouraging is what you see on the right. We exited Q2 with positive trends in several categories. Canned tomatoes improved from -3% to +3.5% dollar growth, and chili improved from 3.6% to 12.3% dollar growth as we effectively manage these businesses for cash. Our supply chain is also performing strongly. As outlined on slide 16, we delivered exceptional service levels of approximately 99% in Q2, the highest sustained levels of service we've achieved as a company. Our first half productivity came in at approximately 5%, which is very robust and keeps us on track to reach our full year target. We also completed our baked chicken modernization project during the quarter, which will enable us to insource previously outsourced production at lower costs going forward. Now let me introduce a new initiative, Project Catalyst, a multi-year comprehensive effort to leverage AI, data, and other new technologies to unlock significant value across our organization. We're reimagining ways of working, transforming end-to-end processes, and connecting our people with cutting-edge technology in ways that will drive efficiency and effectiveness. We have senior leaders mobilized across the organization, are seeing real opportunities emerge, and are getting increasingly excited about its potential. You'll hear more from us about this initiative in calendar 2026, including specific targets for the value we expect Project Catalyst to unlock. So let me bring this all together on slide 18. Based on everything we're seeing, the underlying consumption trends, the inventory dynamics that we expect to normalize, and the robust investment slate we have in place, we are highly confident in our plans to deliver a return to organic net sales growth in the second half. We've recently debuted on-trend, in-demand innovation and have more coming to market. You can see some examples on this slide. Our new Banquet Mega Breakfast Bowls marks this brand's entry into the highly attractive breakfast category. Slim Jim is expanding into chicken with its Buffalo Wild Wings chicken sticks. Dolly Parton is extending into single-serve frozen meals with delicious varieties like this beef pot roast, and Vlasic is building on the success of its pickleball platform with the introduction of new spicy Vlasic pickleballs. We have more merchandising planned for the back half compared to the first half, particularly in frozen, as we expect promotional levels to continue to improve. And we intend to increase advertising and promotional spending in the back half relative to H1 to support our growth businesses. As a result, we are reaffirming our fiscal 2026 guidance today, as you can see on slide 19. Our team is executing well and creating positive underlying momentum. We're seeing continued upward inflection in our growth businesses, and we're on track in our cash businesses. Supply chain service levels and productivity are strong, and we have confidence in our ability to deliver in the back half. With that, I'll turn the call over to Dave to walk you through the financials in more detail. Dave?
Thanks, Sean, and good morning, everyone. Slide 21 shows our financial results for key metrics in the quarter and the first half. As a reminder, we entered the year with plans to invest margin to drive volume. As we mark the halfway point in the year, we've made solid progress against our objectives, and our first half results were largely on track to our expectations. For Q2 specifically, Conagra's organic net sales were approximately $3 billion, a 3% decline versus the prior year. Adjusted gross margin of 23.4% and adjusted operating margin of 11.3% were both down versus the prior year, but slightly better than our expectations, which I'll provide color on shortly. Adjusted earnings per share were 45 cents, down 25 cents versus a year ago. On the right-hand side of the page, you'll see our first half results, including organic net sales of $5.6 billion, a 1.9% decline versus the prior year. Slide 22 shows our second quarter net sales bridge. Total Conagra organic net sales declined 3% over the previous year, with volumes down 3% and flat price mix. Foreign exchange was a 10 basis point tailwind, and the divestitures of Chef Boyardee and our frozen seafood businesses together had a 390 basis point impact. Sean discussed earlier the noise impacting the top line during the quarter. The largest driver impacting organic net sales was a reduction in retailer inventories related to the timing of our merchandising activities. We estimate this was a 100 basis point headwind to the quarter, resulting in a gap between our shipments versus consumption. We expect these shipments to occur in Q3 ahead of the planned merchandising events, and we are already seeing that play out in recent weeks. In addition, we saw a 60 basis point headwind due to lapping favorable trade timing in the year-ago quarter, in line with our expectations. And as Sean discussed, unseasonal weather had a modest impact on results. While our shipments and consumption can be impacted by these timing items, we remain confident in the underlying momentum in the business. Slide 23 shows the composition of net sales by segment. In grocery and snacks, we delivered net sales of $1.2 billion, representing a 1.5% decline in organic net sales versus the prior year, as lower volumes and unfavorable mix were partially offset by inflation-justified pricing actions. Our refrigerated and frozen segment delivered $1.3 billion in sales, with organic net sales down 5.1% versus the prior year. This was driven primarily by lower volumes, inclusive of the impact from the retailer inventory dynamics I just discussed, which slightly over-indexed to this segment, as well as approximately 140 basis points of unfavorable mix due to lapping certain promotional events in the year-ago period. In our international segment, organic net sales declined 2.9% versus prior year, an improvement versus Q1. We saw organic growth in our Mexico region, while Canada and global markets experienced volume softness in response to inflation-justified price increases. Organic net sales in our Foodservice segment posted a second consecutive quarter of growth, with organic net sales growing 0.2% over the prior year. Volume declines were generally in line with Q1 results and were more than offset by favorable pricing. Slide 24 shows that adjusted operating margin declined 406 basis points over the previous year to 11.3%. Price mix was a 10 basis point tailwind as our targeted price increases more than offset the recently discussed trade timing headwind and unfavorable mix. Total inflation remained elevated in Q2, but came in slightly favorable to our expectations. We saw some favorability related to moderating chicken prices, though proteins including beef, pork, and eggs continue to be key areas of cost pressure. Gross tariff inflation for Q2 was in line with expectations. As Sean highlighted earlier, our productivity efforts remained strong in Q2, with core productivity including tariff mitigation at approximately 4.5% of cost of goods sold. Partially offsetting this was unfavorable operating leverage from lower internal production volumes as we focus on optimizing working capital. We also completed our baked chicken facility project in Q2, an important milestone in modernizing our supply chain. Adjusted SG&A, which includes advertising and promotion expense, was 70 basis points unfavorable to year ago, including higher incentive compensation expense as we expected. On a standalone basis, A&P was also slightly higher than a year ago from increased investment, but favorable to our expectations. Our segment-adjusted operating profit and margin results are summarized on slide 25. Overall, the drivers of the segment results are generally in line with the total company drivers just discussed. The adjusted EPS bridge for the second quarter is shown on slide 26. Adjusted EPS was 45 cents in the quarter compared to 70 cents a year ago, driven by lower adjusted operating profit, lower adjusted equity earnings, a higher adjusted tax rate, and reduced profit from divested businesses, which more than offset favorable pension income and lower interest expense. Key balance sheet and cash flow metrics for the first half are shown on slide 27. Compared to the year-ago period, we've made solid progress repaying our debt, with net debt lower by nearly $850 million. We ended the quarter with net leverage at 3.83 times, which was favorable to our expectation. We remain committed to a balanced capital allocation approach as we continue to target long-term leverage of 3 times. Capital expenditures totaled $219 million, and dividends paid were $335 million for the first half, both largely in line with the prior year. As expected, free cash flow in the first half was impacted by our seasonal working capital build, including building inventories ahead of planned merchandising events and lower operating profit. We did not repurchase any shares in the quarter, nor did we have any additional M&A activity in the quarter. Shifting gears, I want to provide a quick update on our joint venture, Ardent Mills. Ardent has performed extremely well over the years, and they play an important role for us through their contributions to our earnings and to our cash flow. The core flour milling business for Ardent has continued to deliver solid results. However, lower prices and lower volatility in wheat markets have negatively impacted Ardent's commodity trading revenue this quarter. Incorporating our updated projections, we now expect adjusted equity earnings to be approximately $170 million versus our prior expectation of $200 million. As Sean mentioned, we are reaffirming our fiscal 26 guidance for key metrics shown here on slide 29. We continue to expect organic net sales change of -1% to +1% versus fiscal 25, adjusted operating margin of approximately 11 to 11.5%, and adjusted EPS in the range of $1.70 to $1.85 per share. Slide 30 provides a bit more color on our expectations for the remainder of the year. For the second half, we expect to return to overall organic net sales growth driven by the wrap of our frozen supply constraints, our recent inflation-justified pricing actions, and the robust investment slate we have planned. Next, cash flow remains a top priority, including reducing our inventory to optimal levels. This opportunity is made possible in part by the supply chain investments we've made and the strong service levels we've achieved this year. We expect to make meaningful progress reducing inventory in the second half, though these actions come with short-term absorption headwinds, which will impact year-to-go margins. In addition, we expect A&P to increase in the second half relative to the first half, peaking at over 3% in Q3. These activations, alongside the innovation and merchandising plan, further our priority of investing to drive volume in frozen and snacks. Taken together, these actions are expected to result in Q3 adjusted operating margin below our Q2 result. For the full year, our estimates for total inflation, including tariffs and total productivity, are largely unchanged at approximately 7% and 5% of cost of goods sold, respectively. While more recent changes to tariff policies are generally favorable, the impact to Conagra is limited given our primary exposure to tin plate steel. On an absolute basis, we continue to expect tariff expense net of mitigation to increase sequentially as we progress through the remainder of the year. We also continue to expect full-year A&P at approximately 2.5% of sales and adjusted SG&A, excluding A&P, at approximately 10% of sales, both unchanged versus our prior expectations. And last, as I mentioned, we expect adjusted equity earnings to contribute approximately $170 million. And finally, slide 31 outlines our additional fiscal 26 guidance metrics. Aside from the change to adjusted equity earnings, our expectations for each of the other line items shown remain unchanged versus Q1. That concludes our prepared remarks for today's call. Thank you for your interest in Conagra Brands.
I would now like to turn the conference over to Matt Nicias. Please go ahead.
Good morning, everyone, and thank you for joining us. Once again, I'm joined this morning by Sean Connolly, our CEO, and Dave Marberger, our CFO. We may be making some forward-looking statements and discussing non-GAAP financial measures during this Q&A session. Please see our earnings release, prepared remarks, presentation materials, and filings with the SEC in the Investor Relations section of our website for descriptions of our risk factors, GAAP to non-GAAP reconciliations, and information on our comparability items. I'll now ask the operator to introduce the first question.
Our first question is from Andrew Lazar with Barclays. Please go ahead.
Great. Thanks so much. Happy holidays, everybody.
Morning, Andrew.
Morning. Sean, maybe to start off, you've mentioned in the prepared remarks that you're seeing some of the delayed shipments materialize in December. On top of this, you've got easier comparisons starting in frozen, a return to full merchandising and a full innovation slate that you've talked about, and then some pricing in staples brands with so far, expected elasticity. So I guess all in, would you be expecting positive year-over-year organic sales in fiscal 3Q, or are there other things in the third quarter that we need to keep in mind?
All right, let me break that down for you. I like what I'm seeing so far in December, as we mentioned in the prepared remarks, and I like where we sit going into the second half here with some momentum. We don't provide formal quarterly guidance, but I will say that overall we do expect organic net sales growth in the second half. And as for the quarterly flows, if you incorporate the information we're sharing today into your models, you will get a more accurate balance between Q3 and Q4. Dave, you want to add any color to that?
Yeah, Andrew, I think you hit it with the shift in the kind of the trade inventory from Q2 to Q3, wrapping the supply constraints from the prior year, and then wrapping the unfavorable Q3 trade adjustment a year ago. They're the three big things.
Great. Thank you for that. And then earlier this week, Sean, another food company mentioned a higher cost of volume as shoppers are increasingly sort of waiting to buy more of their needs on promotion. It's not that depth or frequency had changed much. It's just amount of a product being sold on deal. And it's partially, for them at least, seems to be coming at the expense of base or sort of full price volume. I'm just curious if you're seeing the same thing at this point or expect to. You have some vagaries, obviously, because you're getting back to full merchandising in the back half that you didn't have last year. But just trying to get a sense of what you're seeing more broadly in the industry with regard to that sort of dynamic. Thank you.
Yeah, good question. I saw that regarding cost of volume, we have not seen what you just described. We built our plan to invest margin for continued upward volume inflection in frozen and snacks. And coming into the year, when we built the plan, we fully understood the cost of that inflection from last year, when we strung together 6 straight quarters of consistent volume progress prior to running into those temporary supply constraints in frozen that we've talked about previously. So what we're seeing this year is unfolding very consistent with our expectations, which of course was based on last year's experience, in terms of both costs and lifts.
Great. All right. Thanks so much. See you in February.
See you soon. Thank you.
Our next question comes from Tom Palmer with J.P. Morgan. Please go ahead.
Good morning, and thanks for the question. First, I just wanted to, clarify on the annual outlook. You reiterated sales and operating margin. You did take down Ardent. I think the $30 million is around 5 cents to EPS, if I'm doing the math right. So I guess I'm just trying to bridge. I know there is a range here, but is there something that kind of helps to elsewhere in the P&L that helps to make up for Ardent? Thank you.
Yeah, Tom, this is Dave. As you can see, through the first half, our operating profit and our operating margin performance is good. Now, there's a lot of kind of puts and takes in terms of performance both for this quarter and the first half, but we feel good about the momentum. We've had some favorability with the tariff timing. That was more Q1. We've had some favorability in chicken inflation, although we're seeing some offsets with beef and pork. And importantly, our core productivity programs are really on track. So we feel good about that, and we feel good about the second half. And Sean just talked about we're forecasting positive organic sales growth for the second half. Some of that, we do have some headwinds from absorption. We talked about that in the call, and that's just simply us being really diligent in managing our working capital, our inventories, because we're really tracking well on cash flow, and we want to make sure that we deliver those numbers. So just given the momentum we have, Tom, and kind of how we plan the year, we think that we can cover the shortfall in Ardent and still stay in the EPS range.
Yeah, Tom and Sean, just to remind everybody of one other factor, we guided to a wider range this year than we normally do because we were very clear-eyed that it's a volatile environment and there can be things that unfold that are very difficult to predict. That's one of the reasons we put out a broader range this year so that we could navigate things like what you've seen in Ardent and the trading piece of the business and still hit our guidance. So we like where we are.
Okay, thanks for that color. And look, I appreciate more coming here in calendar 26, but I did want to just ask on Project Catalyst, as we think about its potential impact and implementation, should we be thinking about, like in some past programs, you've had very clear cost savings targets, and then any sort of like stepped up spending, be it CapEx related or other types investments that we should start thinking about? Thank you.
Sure. Let me give you just some more color on Catalyst. So in CPG, you've got big core business processes that for, the better part of a century have been heavily manual in nature and therefore not perfect. Let's put it that way. Now with technology kind of being democratized for even industries with our margin structure, the access to technologies to automate a lot of these business processes is kind of in an unprecedented place. And that's a pathway to more effectiveness and more efficiency going forward. So we've got a fully dedicated team led by some of my most senior leaders to make sure that we implement this. And it's basically a re-engineering of core business processes using tech, especially AI, for more effectiveness and more efficiency. There undoubtedly will be time to complete the project. There will be costs to complete the project. Then there will be a return on the project. And based on what we're seeing after being at this for several months, we're very excited about the potential. And during calendar 26, we'll unpack this in more detail for our investors.
Okay, thank you.
Our next question comes from David Palmer with Evercore. Please go ahead.
Great. Thank you. Just one big picture question. And just looking across your big two retail segments, consumption trends on a 2-year basis would seem to imply return to growth in the second half of this fiscal year. But then again, a modest decline in the first half of fiscal 27. And I only mention that because obviously I'm trying to sort through the noise of supply chain, not just for your shipments, but for your consumption trends as well. So I guess I'm interested in whether you think multi-year trends can improve or, just maybe point to the things that you're working on to improve that setup into fiscal 27, because I'm looking now and the street's anticipating some organic sales growth in fiscal 27, but also some earnings growth in that year as well. And any thoughts there? Thanks.
Sure. Well, David, the two growth domains for our company are, as you know, are frozen and snacks. And so snacks is already, as you saw in the numbers today, growing very robustly and benefiting from things like the bounce back in C-store with gas prices. So we're already at, extremely strong growth on snacks, and we've got a very strong snacks marketing plan in the back half of the year to continue the momentum we've got, especially on Slim Jim and Fatty. So that's already growing robustly. Frozen, I know you've had a write-up recently on frozen, and you could see in our prepared materials today, I wouldn't pay too much attention to Q2 year-on-year in frozen because we had a blockbuster frozen quarter in Q2 last year. And our goal this quarter in frozen was to reclaim the market share that we basically loaned out to a competitor when we had supply constraints beginning last winter. And as you can see in the market share charts today, we've clawed back almost all of that. In our biggest business, frozen single-serve meals, we're almost up to 53, which is pretty much the high water mark for us there. So on a 2-year basis, when you factor out the fact that we had a huge quarter last Q2 and we didn't repeat the same promotions this quarter, it's actually a very impressive quarter with good upward momentum. And as you look at the back half of the year on that business, on frozen, you're going to have more high-quality promotional activity than we had last year because we were basically out of business on promo last year. And the baseline is looking good as well. So, and we've got good advertising and innovation and things like that. So we've got good momentum in the underlying trends on our frozen business. Vegetable, I think, is back to a record share, and we've got really good program in the second half. So that all bodes. Obviously, it's too early to talk about 27 right now, but we're going to have very good momentum on frozen as we go into 27. And snacks is already, as I said, growing at near mid-single digits.
Great. Very helpful. Thank you.
Thank you.
Thanks, Dave.
Our next question comes from Peter Galbo with Bank of America. Please go ahead.
Hey, guys. Good morning. Thanks for the question. Sean, I just wanted to get your perspective. You've now had 2 of your largest peers not only talk about but start to enact price cuts. And just, asking kind of for your crystal ball into the back half of fiscal 26 and even into early 27, just what that potential activity from some of your largest peers could mean for the group and how you think it translates to some of the actions you all may need to take. Obviously, considering that you've announced some pricing in some of the staples portfolio. So would just love your perspective on that, please.
Sure. I'll try to give you some color on that, Pete. We don't have a tremendous amount of overlap with some of the other big food companies that you've seen. And in frozen, we're far and away the market leader in our big business. And in our specific snacks categories like meat snacks and seeds, we really don't interact with a lot of the other big food companies. But the way to think about pricing with respect to Conagra is that we have not rolled back price in order to move volume. What we effectively have done on frozen and snacks is we did not take pricing, inflation-justified pricing, to protect margins. We kept pricing where it was so that we could then layer on a very reasonable and high-quality promotional business that's consistent with what we've done in years past and get those businesses to growth. And that's what we've seen. So we've seen the desired inflection, and in some parts of the business, we're already back to growth. Without lowering list price, we just deferred taking inflation-justified pricing because we were focused on moving volume. So it's a little bit of a different nuance than lowering prices in order to move volume. And when you look at our % volume sold on deal and you look at depth of discount, you do not see anything beyond what we've done historically. If anything, we're more conservative than what we've done historically. So I guess the net of that is, I would say the volume inflection we're seeing is very efficient, and that's good, and that makes me feel good about this cost of volume concept and how we feel about our guidance for the balance of the year. What part of your question did I miss, Pete?
No, I think you hit it, Sean. Thank you. Very, very comprehensive. Dave, I was hoping to ask a follow-up around just the inflation guidance. I think you talked about maybe, and apologies if I missed it, but you talked about some favorability in the quarter. You've mentioned things like chicken. Just where is inflation running? Like, where did we run in the first half and maybe in the second quarter specifically, and then how we think about that in the context of the 7% for the year? Thanks very much.
Yeah, sure, Peter. Just as a refresher, so we had talked about our core inflation, our guidance for the year, our core inflation a bit above 4%, and then gross tariff inflation of approximately 3%. So 7% has been our total gross inflation guidance for the year. We're still on track with that, Peter. We have seen some kind of puts and takes. Like I said, we've seen favorability in chicken, but we're forecasting increased cost in beef and pork, and so we have some offsets there. We see some favorability in tariffs, but remember, more than 50% of our tariff exposure is on tin plate, and there's been no change to those tariff levels. And also, the areas where we've seen some of the tariff come down, our mitigation has come down as well. So it's not a significant impact on the overall year. So I would say our original kind of inflation guidance of 7% and net of 5.5% is still where we are.
And Dave, just sorry for clarification, you ran at about 5% gross inflation in the second quarter. If I look at slide 24,
it was closer to 7 because that's the margin impact that you see on the bridge. So we were gross inflation around a little bit south of 7.
Okay, thanks very much, guys.
Yep.
Our next question comes from Max Gumport with BNP. Please go ahead.
Hey, thanks for the question. Your prepared remarks mentioned that 3Q operating margins are expected to be below 2Q levels due to A&P and then also some absorption headwinds associated with reducing inventory. I realize you've framed A&P as going to over 3% of sales in 3Q, but is there any way to size the magnitude of the absorption headwind that you'll see in 3Q? Thanks very much.
Yeah, what I would say is if you look at gross margin, Q3, it will be similar to where we landed in Q2, maybe a little bit better, but again, there's a lot of puts and takes with absorption and absorption timing, so we don't like to get too specific on the quarter. The big impacts, if you look at Q3 operating margin relative to Q2, is over 3% A&P, and SG&A as a percentage of net sales will be higher than Q2 as well. So they're really the two drivers. Gross margin is going to be pretty much in line with what we delivered Q2.
Great, thanks very much. And then longer term question, just looking back at your gross margin over time, clearly it was running in the high 20% pre-COVID. It looked set to end this year around the 24% level, so several hundred basis points below historical levels. And I recognize there's reasons for that. There's investments you've made this year and there's also meaningful inflation that you're not offsetting with price given the consumer environment. I'm just wondering, as we look out over the next several years, is there anything that you're seeing that would prevent you from getting back to a high 20% gross margin level? Thanks very much.
Well, we plan on clawing our way north on gross margins. So we absolutely expect margin expansion going forward, particularly in frozen, and the building blocks have not changed. It starts with productivity. So our productivity is running now at about 5%, which is very strong. At some point, we're going to get inflation relief here, hopefully back to a typical 2% level. The third piece is the advancement of our supply chain resiliency investments, including our chicken plants. And over time, we're going to have the ability to repatriate the outsourced production, which will be another tailwind to margins. And we are taking pricing in certain categories, as you saw in our documents today. And then the last thing I'll point to is Project Catalyst. This re-engineering of our core business processes using technology will be another meaningful contributor. So between those actions and the ongoing efforts to reshape the portfolio for faster growth and better margins, we do expect good margin expansion following F26.
Okay, great. Thanks very much.
Thanks.
Our next question comes from Robert Moskow with TD Cowen. Please go ahead.
Hey, thanks for the question. Dave, I wanted to ask about the assumption of a 100 basis point headwind in 2Q and the extent to which it can reverse in third quarter. Because some of it sounds like it's the thought that retailers are just not ordering as much and in relation to consumption, and then they're going to do it in third quarter because they don't have to worry about the SNAP issues or other issues. But, retail inventories have been notoriously difficult to predict. Is there a risk here that retailers just decide to go forward with less inventory than normal for the rest of the year just because they want to be more efficient? And if so, is it maybe more so in the frozen area than the shelf stable? Thanks.
Hey, Rob, it's Sean. I'll give you my color on this. So the way to think about our company, our portfolio is we've got a baseline of volume that is pretty steady across, all 12 months of the year. But we also then, on top of that baseline, starting usually in the fall, there is another line, which is the seasonal promotional build, because we have a lot of seasonal products in the Conagra portfolio, products that are huge traffic builders at our retailers. So the retailers have that promotional seasonal volume build in terms of what sells, what scans through in their base. And every year they are determined to wrap that successfully, meaning, at least achieve what they delivered a year ago, if not grow a year ago. And promotions are absolutely essential during the seasonal period to get to that level of absolute volume. So the promotional volume always comes. The seasonal inventory build always comes. It's usually just a dynamic of, does that build fall into Q2 or does that build fall into Q3? And sometimes it's linked to Thanksgiving timing and whether or not Thanksgiving's in Q2 or Q3. Sometimes it's linked more to the promotional calendar, and is the promotional calendar queued up so that it's earlier, like it was last year where we had our heavy promotions in frozen in Q2. Those big promotions in frozen this year are disproportionately moved to Q3. So the way I think it's pretty simple to think about it is, retailers have to start the holiday seasonal kind of inventory build at some point. Whether or not they started earlier or later is a function of when is the promotion, and this year uniquely a function of the government shutdown and kind of the SNAP pause. Because what I believe it happened with some retailers is, anticipating a slowdown in consumer takeaway because of the SNAP pause, they manage their working capital too, and there's no reason to build inventory. If you've got a pause on the near-term horizon, you can build it later. And so we've already got most of December in the books here, and so we've had a chance to see how orders are shaping up, and it's unfolding in a manner very consistent with what I just described.
Okay, very helpful. Thanks, Sean.
Thank you.
Our next question comes from Alexia Howard with Bernstein. Please go ahead.
Good morning, everybody. Can I ask about innovation? Firstly, are there any numbers you can put around where you're at? And I assume that you're now significantly above where you were a few years ago during COVID. Are you now at a sort of level that you feel comfortable with maintaining, or is there more increase to come? And then sticking with the innovation theme, I wanted to ask about how you're leaning into the health and wellness trends. It seems as though there's a lot of health and wellness themes going on out there. Walmart has said that they're going to eliminate 30 additives from the whole of their private label portfolio. We've got potential food labeling, front of pack legislation coming in, dietary guidelines coming up as well. I remember you talking about GLP-1 on-pack labels. How is that all going, and what are the priorities from here?
Yeah, great question, Alexia. The innovation performance over the last several years has just gotten better and better and better every year, and it was good to start with. So we've wrapped really good innovation years, and each year we make progress in innovation, both in terms of TPDs that we're able to secure, but also velocity per TPD has gotten better and better, and this year is better than last year, and last year was better than the year before. So I'm very pleased with where we are on innovation, and we'll continue to share more about some of the success stories that we've had with innovation. But I think your second question speaks to also what's driving a lot, not all, but a lot of the innovation success. There's undoubtedly a lot of consumer focus these days on health and wellness, and has been the case for 50 years. Kind of the definition of what does good health and wellness food look like in 2026 is different than it looked 10 years ago, which is different than it looked 20 years before that. So right now, health and wellness is heavily, as everybody knows and can see, heavily about protein. So the presence of protein in products is hugely important to consumers. That's a major part of our benefit bundle that we've baked into a lot of our innovations. I would say, secondly, clean label continues to be really important, as well as vegetable nutrition. So if you think about our portfolio with brands like Bird's Eye Vegetables, which are just awesome vegetables, flash frozen at the peak of ripeness. You think about protein, meat sticks, as well as seeds. You think about our frozen businesses like Healthy Choice, which are incredibly clean label, incredibly healthy, high in protein, low in sugar, low in carbs, things like that. It's very well positioned. And so I probably feel like our portfolio is as well positioned today as it's been to compete in a world that's very focused on health and wellness. And one of the things I find most interesting about the double click on that is it's young consumers. Young consumers, which we over-index with, are more focused on health and wellness than I've seen in a while, and it is playing right into some of our tailwind businesses like our protein-focused brands. And that's a real positive, and you see it in categories outside of food, like they're drinking less, things like that. And so, you get a good return when you can secure young consumers because you keep them around a lot longer. And we've had really good progress with our young consumers. And that's helping us because obviously young consumers also tend to be lower income consumers because they're getting started in their career, and we have a lot of good value products.
Very helpful. Thank you very much. I'll pass it on.
Our next question comes from Leah Jordan with Goldman Sachs. Please go ahead.
Hi, good morning. Thank you. So you're stepping up your A&P spend in the back half. Just any color on how we should think about the balance between the two quarters? And with this step up and the fact that you're calling out that consumers are still value seeking, has anything changed in your approach for this spend, be it across categories, channels, or frequency, anything there? Thank you.
Well, that's a very insightful question, Leah. One of the things you will see us incorporate into our advertising this quarter is an increased emphasis on relative value. We always talk about the quality of our products. That will go unchanged. But the relative value of our products versus things like quick-serve restaurants, things like that, is undeniable. And sometimes you have to remind consumers of that because while prices might be higher today than they were 3 years ago, relatively speaking, it's hard to beat the value and the quality that our products offer. And that value message is that really value as a priority area is being very woven into our innovations themselves. Some of our innovations coming this year will be more value-oriented, and our marketing messages will be value-oriented. And we think, given the inflection we've already got, that will continue to push some of the light or lapsed users back into the franchise and continue to help drive our organic sales growth.
Okay, great. And then I just had one quick follow-up on the weather piece in the quarter, specifically related to the slow start to winter. Now that we've shifted to much colder weather across the U.S., just seeing if there's any color commentary around quarter-to-date trends. Have those normalized with your expectations or anything to think through there? Thank you.
Yeah, the weather outlook certainly changed, didn't it, in the last couple of weeks? That's great for us. As I mentioned, just to put a fine point on this, there were two weather things in the quarter that we noticed, and they're tangible, so we'll just kind of unpack them. One is this hurricane thing. You probably wonder, what is this hurricane thing? Well, we've had hurricanes for 10 years and that hit the continental U.S., and when we have hurricanes hit the continental U.S., we sell a lot of food in Florida, particularly canned food, also along the Gulf Coast, sometimes the East Coast, and so that's kind of captured in our base. And last year we had an unusually high hurricane quarter. We did not plan for that this year, but we planned for a normal quarter. We didn't get any hurricane. So that's fortunate for the people along the coastline, but it was a little different than we planned. So that was a bit of a headwind. And then the question around when does the cold weather kind of roll in tends to affect when do we start to see that seasonal ramp up in our canned food, cooking ingredients portfolio like tomatoes or even canned chili. And so it always comes. It's a question of, is it going to come early October? Is it going to come November? So it came a little later than normal, but obviously since the quarter's turned, you've seen very cold weather, and you already know what that does to businesses like cocoa and canned tomatoes and chili. So yeah, that's another timing factor.
Okay, great. Thank you.
Our next question comes from Megan Clapp with Morgan Stanley. Please go ahead.
Hi, good morning. Thanks for squeezing me in. I just had a quick follow-up to Tom's question earlier on the EPS outlook. You mentioned you seem confident on offsetting the shortfall from Ardent. The range is still quite wide. Sean, you mentioned it was wider than normal coming into the year. So can you just help us understand what are kind of the key swing factors or uncertainties that remain that justified keeping the EPS range wider now that we are halfway through the year rather than narrowing it? Thanks.
Yeah, I wouldn't overthink keeping it wider. We are just at Q2. So when we narrow the range historically, it's usually in the back half of the year. As we move toward the end of the year, it's usually not in the first quarter, even after the second quarter. So I wouldn't read much more into that other than we're just now finishing up second quarter, and we got the second half to go, and we'll update that range again next quarter.
Okay. And then maybe just another follow-up on, I think it was Andrew's question at the beginning. So you talked about in the slides and in your prepared remarks the 2-year consumption trends in refrigerated and frozen inflecting back to positive. We know that the reported numbers are pretty noisy, and I know you don't want to provide guidance, but as we look to Q3 and just consider the momentum you're seeing in consumption on a 2-year basis and all of these timing shifts and what we'll see in terms of the shipment timing benefit, would you expect that 2-year reported trend in R&F to accelerate versus the first half? I'm just trying to get a sense because the street does imply a bit of a deceleration, so just trying to understand how to think about that segment in particular given the noise. Thanks.
I think you can expect a good second half in frozen. I mean, it's not a lot more complicated than the underlying trends are inflecting northward. Our market shares are either already back to the high water mark or very close to it. The programming that we've got in the marketplace in the next quarter will be stronger than we've had not only in the last quarter, but significantly stronger than a year ago, because a year ago we were basically out of business in the quarter on promotions because of the supply constraints. So all of that lends itself to high quality underlying momentum in the third quarter and in the second half.
Okay, great. Thanks, Sean.
Thank you.
Our next question comes from Chris Carey with Wells Fargo. Please go ahead.
Hey guys, just regarding the inflation for this year, like there's some puts and takes, but it's basically tracking to where you thought. Is there any reason why it shouldn't be back in that 2-ish% range going into next year based on what we can see today? Are there anomalies with the timing of some of the pork and beef inflation that you're seeing, or are there tariff carryover into next year with inventory? I think the comment was we'd like to get back to that range over time, but I just wondered if there were anomalies that you're thinking about that would prevent you from getting there going into next year.
No, Chris, I feel like I'm more cautious on prognosticating about inflation now than I probably have ever been. But we've looked back 100 years at these inflation super cycles, and when you hit these kind of peaks on any individual commodity that have been unprecedented, you usually see a downward slope on the other side of that hill. We just have not, as an industry, experienced that yet. In our case, it's been a bit more challenging than some portfolios in that we're heavily skewed toward proteins, which of course remained high. But proteins go up and they usually come down. So, and obviously different proteins have different timetables for that delta. So at some point it's going to normalize here. At some point very soon we're going to have a lot of this stuff baked into our base already. So you could really start to see some relief in the P&L if things start to break our way.
Okay, we'll see how it goes. From a portfolio standpoint, it's a little bit bigger picture. We've seen a ton of activity, in the food sector with, portfolio changes, separations, combinations, and actually in broader staples as well, even outside of food. When you think about what's going on in the environment right now, can you just give us the latest on Conagra's approach to its portfolio, how you think through portfolio opportunities one way or the other, and just how the balance sheet and your leverage targets factor into your medium-term objectives? Just any context would be helpful.
Sure. Well, first of all, just to remind the listeners on the call, we have done probably more M&A than most of the companies in our space over the last 10 years, and that includes inbounds and a lot of divestitures, even separations. So we're quite familiar with that. And of course, prior to being here, I was at Sara Lee, where we had a split and we stood up 2 independent companies and had a good outcome. So, Dave and I and the board are always thinking of everything under the sun in terms of ways to create value for our shareholders. And we are not the slightest bit entrenched in any way. If there is a clear path to creating value, we will pursue it, and we have done that in the past. So reshaping has always been part of our game plan, and that has included inbounds from time to time. I don't see us doing that anytime soon because we're focused on debt reduction. But it's also included outbounds, and we only recently completed the divestiture of Chef Boyardee, and while we sold some EPS with that, we felt like it was the right thing to do for the portfolio long term. So we'll continue to look at our options there, and if we see a clear pathway to value creation, we are always eagerly in pursuit of that.
Okay, thanks, Sean.
Our next question comes from Scott Marks with Jefferies. Please go ahead.
Hey, good morning, all. Thanks so much for taking our questions. Wanted to ask about the completion of the baked chicken facility. Could you just remind us how you're thinking about cadence of repatriating some of that production and how we should be thinking about the magnitude and cadence of the margin improvement from those actions? Thanks.
Sure. I'll make a quick comment, and then I'll flip it to Dave. But it's amazing. Chicken's always been an important part of our portfolio, but chicken's just been on fire over the last several years. And, our historic business was mostly kind of roasted or baked chicken, and that's where we ran into some of the supply challenges last year. We got some quality inconsistencies. We fixed those. That's done. So the baked chicken project is complete, and we like the way that looks, and that's great. But as you know, we also, in the last year, had some tremendous success with our new Banquet Mega Filets, which is a fried chicken product that basically looks a lot like a Chick-fil-A product. And that's an area where we've had limited capacity going forward. So we've elected to make some additional investments there to increase our capacity. It'll take some time to build that out, but that's super exciting because chicken as a protein has just been on fire, and in part because beef has been so expensive for the consumer. But I would say even overall, when you look at food service trends and the success of Chick-fil-A and Raising Cane's, things like that, it's just been undeniable. So we're very excited about that being a continued tailwind for us, and getting those capabilities in-house enables us to make these products in the most efficient way possible with the best margin. Dave, you want to add to that?
Yeah. So as we communicated at the beginning of the year with our guidance, we had estimated completing this line, this production at the end of the second quarter, which we have. So now we're in transition of bringing volume back in from the third party. As you can imagine, there's a transition there, and we build inventories and we deplete inventory. So, but all of that was built into our guidance, our margin and profit forecast for fiscal 26. So we're on track, and that's incorporated into what we've guided to.
Understood. Thanks. And then just quickly, second question for me, there was a pretty sizable impairment charge taken in the quarter. I don't believe I saw any details in the press release, so I'm wondering if you could just share any insight around that. Thanks.
Sure. So we had obviously have had a sustained decline in our stock price and market cap. And so the way that you do impairment accounting, if there is a triggering event, and this would qualify for where if your stock and market cap over an extended period of time is lower, you have to go back and do all the analysis you do for goodwill impairment and brand impairment. So we always do this work in our Q4 every year. So the last time we did it was at the end of our third quarter for our fourth quarter last fiscal year. So we had to do that in the second quarter. And when we went through that process, given the macro backdrop, which has impacted the stock price, obviously, we made the decision to increase our discount rate. So a lot of our forecasts were the same. And as you see, we're holding our guidance. So we feel good about where the business is going. It's in line with expectations. But because we changed our discount rate, that drove the impairment. So it's really just marking kind of book down to the fair value.
Understood. Thanks so much. Happy holidays.
Thank you.
At this time, there are no more questions. The conference is now concluded. Thank you for attending today's presentation. You may now disconnect.